Exactly what happens to your bond investments when interest rates go up? And what should you do about it? I'm Jack Otter, editor of BARRON'S.com. I'm here with Bill Gross, known as the Bond King, the co-chief investment officer of Pimco, and of course, a longtime Barron's Roundtable member. So let's get the numbers out of the way first, Bill. We had some discussion today about a 10-year bond at 3%, which is about where we are right now. If yields should jump to 4%, how much does the holder of that 10-year bond lose nominally?
And that's what I call the teeter-totter principle. When interest rates go up, bond prices go down, vice versa, a teeter-totter. And to answer your question specifically, it depends on how long it takes. But if it took a year, this time next year, if interest rates went from 3 to 4, the bond's price would be approximately 8% lower, but the 3% interest rate or coupon that you mentioned would sort of cushion that to 5%. So an investor, in terms of higher rates, 1% over a year's period of time has a 5% potential loss. It works the same way
when rates go down.
When rates go down. But of course you add in the coupon, and so you'd have approximately an 11% gain. So 5% down, 11% up.
Gotcha. Okay, now let's talk about some of your big picture views of what's going on in the U.S. economy right now. You did see a couple of worrisome trends. Would you talk about a few of those things that are on your radar?
Well, I think generally, Jack, on a global basis in the United States, the economy is too highly levered. That means that individuals and households with student loans, with mortgages, with credit cards. It also means corporations and government. We know the U.S. Treasury has been a big borrower of money, and so all in combination has produced a situation that is quite similar to 2008 and 9 in terms of the total amount of debt relative to our gross domestic product, and that's the measurement that most analysts use. I would use that to say, the balloon that was blown up in the certain parts of the last decade, it hasn't been popped, it hasn't been expanded anymore, but it still remains at a pretty high level, such that if something were to occur, that you might see a deflation of that bubble, perhaps not a popping, but that's one of the things I worry about.
Let's talk about one other thing to worry about. I mean, you are a bond investor after all. That's what you guys do, is worry. So when we're talking about profit margins, right now they're at a pretty high level historically. Right. And one of the things you've identified that could lead to those coming in a little bit is a trend in terms of how much people are getting paid. We all know that revenues haven't been going up that much. Companies have been improving margins partly by cutting back. Right. So labor, you said, has not seen too much of a share in the gains, and that could change.
Yeah, they haven't, and the recent statistics over the last 12 months, and indeed over the last few years, shows that labor, that their income has grown by 1 or 1.5%. As a percentage of GDP, corporate profits are at record margins going back into the 50s, maybe back into the 40s, 14% of GDP. Household income, in other words labor, basically has gone down as much as corporate profits have gone up, currently at about 54% of GDP. And so my concern is that ultimately, just to use a metaphor, there's only so much juice you can squeeze out of an orange. We know that. And there's only so much profit that you can allocate to corporations, as opposed to giving some of that back to labor.
To the customers.
Yes, and I wouldn't expect an individual corporation to volunteer, but in general, that's what's happened, is that corporations have been the winners, households have been the losers, and at some point, if capitalism is to continue in the successful way that it has, there should be some rebalancing in order to have corporations make money.
Well, that makes sense. Yes. So within that environment, where are you seeing some interesting investment opportunities?
Well, I have a number of them, but I think it's an environment in which investors on the bond side should be concerned about principal, that teeter-totter that you talk about, losing money, but they need some income as well. They need more than 10 basis points on a treasury bill or a money market fund. And so, I have several suggestions. One is the an ETF, which can be bought easily in the public market. It's goes by the symbol of HYS. It's a Pimco 1 to 5 year high yield ETF. It has a short duration, which protects you principal-wise. It's got a yield of 4.5% to 5%, and so it's relatively safe, not perfectly safe, relatively safe, and a decently attractive yield in the ETF space. Some other closed ends that I'll be recommending. One of them, the Pimco Municipal Fund, symbol PML, that provides a tax-free national income of 7 to 7.1%, and doesn't have any Puerto Rico and no
Detroit.
No Detroit.
Okay. And is that selling at a discount right now? Often these are.
It's flat.
Oh, okay.
Just right at the zero line. So it's not at a discount, but it used to sell at a big premium. So from that standpoint, it's cheap.
Thanks very much, Bill.
You're welcome. Thank you.